Hey traders, welcome to Charts and Coffee. Happy Tuesday, everybody. All right, so we are taking a look at probably one of the most important days this week in terms of FOMC communication, meaning that if we're looking at how the FOMC is going to communicate their plans in May, we have I don't know, 3 or 4 speakers today. I'll have to double check. We have 3 or 4 speakers today. We have the FOMC minutes tomorrow. So we have a lot going on in the next couple of days as it pertains to what we're going to see with the messaging around quarter point hike versus half point hike. And half point hike is in the 70s, low 70s in terms of probability at the moment. So very high likelihood for a rate hike of 50 basis points or a half a point. Does the market know this? Yes. In fact, if that is the most highly discounted, it's also the most highly probable. It's also the most widely expected. And this is when we start using phrases like it's baked into the cake, right? So interestingly enough, even after we've gotten out of the end of quarter, the end of March shenanigans, the broader averages, I'm taking a look at the QQQ, the SPY, the DIA, here's the IWM, all but the IWM is trading above the 200 exponential, 200 propulsion. Those are the white dots cutting across my screen there. So the most bearish of the 4 indices, if you're looking at Dow, S&P, NASDAQ, and Russell, the most bearish is the Russell. And if we're able to get to that 200 again on the Russell, wow, look at this. We've got the 200. We've got a pretty decent little volume ledge sitting at about 212 on the IWM. Great spot for potentially a short. Am I still bearish? Overall, there's kind of a conflict. In other words, I've got on one hand, the S&P still in bullish momentum, but overall neutral trend. And that neutral trend is what keeps me watching the slow stochastic, is what keeps me looking for some sort of overbought ceiling, resistance level overhead. But we're also north of the 200 exponential, that 200 propulsion, which is the bullish hemisphere, as you know, I refer to it. So we've got a little bit of a conflict at the moment. And this is where I'm going to go back to what I shared with you all in the weekly notes here at Simple. I'm going to go back to what we talked about in the Sunday show. And that is, it's probably been the least effective and the least necessary to concern yourself right now, and even to be trading most of the broader averages, sans the IWM, which I see still has a good overhead technical resistance level, and we're below the 200 in that bearish hemisphere. And most of the sectors are in various degrees of absolute mess chop. Keep an eye on the XLF, however, not my favorite in terms of structure, but in terms of price, where we're sitting right now, really neat that we're hovering just above the 50% Fibonacci. In other words, you take a look at the last major move, and keep in mind, last major move just drives home the fact that when we're looking at Fibonacci levels, it's expansion and contraction. I think one thing when it comes to Fibonacci, whether that be Fibonacci numbers, Fibonacci levels, Fibonacci is not a trading tool. I know, wait, Rog, what? No, Fibonacci is a mathematical law of nature. We just happen to apply it to the nature of the markets, right? The Fibonacci number sequence is used in chemistry, architecture, biology. You can find the Fibonacci ratio in nature everywhere. I have one of these cool little Nautilus looking shell things with a Fibonacci ratio. It's amazing. So now we're applying Fibonacci to the markets. Remember, think about what it's designed to measure: expansion and contraction. So you want to find those expansion, in this case, what I call the last major move, the most significant unretraced rally or sell-off. And this is the last major move, high to low. And usually it's a minor low to minor high, or a minor high to minor low. Amazing how that works too. So 50%, 200 happening in a very similar level. That's a really good zone to keep an eye on. And then we have this volume ledge happening in here. We have the 50% to 200 happening in here. Really neat zones, I think, to keep an eye on in XLF, which just drives home the point that we still have a lot of chop in this market. Bullish momentum does not, at this point, equate to bullish trends across all the indices, actually across any indice, and most of the sectors are still choppy. So keep in mind, XLE, that's in a trend higher. XLV, that's in a trend higher. Different housing and construction ETFs, open positions that we have in the sector secrets mastery, those are in trends lower. So prioritize the trends, my friends. They are out there. Trendalorian. All right. So as always, gang, this show is about your questions. So we are going to go ahead and jump into those questions right now. And let's kick it off with, here we go. Hey there, Mike. How are you? All right. So taking a look at, let's see, can we use the VIX, the VIX, to determine where we can get short again? You know, Mike, I'm not a big fan of the VIX or the VXX. I look at the futures, the VX futures. That's number one. And as far as a directional indication, the VIX sitting, where it's at right now is actually at the lower end, as you can see, the lower end. Now, look, Mike, I will tell you this. I don't use market internals that much unless they are quite literally the internals of the indices, the stocks that make them up, the sectors that make them up, and or currencies. I'm not a big fan of internals like VIX or trend or what have you, put call ratios. I really just don't pay much attention to them because they're general environments. They're not setups. So actually where the VIX is right now, I'd be careful getting too bearish. I would actually be a little careful. But I don't think that the VIX is necessarily going to decode the markets as well as, and from a timing perspective, right? From an environment, I think generally speaking, we could be seeing the VIX move a little bit lower, which would then possibly set up maybe a move back to the upside. Again, I don't think that they're that correlated, right? And so you might say, okay, Rod, how would I show myself whether there's correlation there or not? So take a look at the SPY, right? So pull back. Actually, let's do this. Go to the VX futures. So if you're on TOS, it's /VX. If you're on TradingView, it's VX, the number one exclamation point. And then go grab the peak. Go grab where the market peaked. So let's look at 7-8 of March. Now let's go to the SPY, right? Now also look at 7-8 March. We're at 7-8 March right here. So you might say, okay, Rod, when that thing started peaking and then dropping not too far later, we actually retested it, but not too long after, the S&P moved higher. But you see, it wasn't a candle for candle correlation. But again, from an environment perspective, if the VIX is coming down, see how the VIX just came right down? It's tough to continue to think that the indices are going to keep sinking if the VIX is now sinking as well. And that's the way I look at it. Again, it's not a setup, but it is sort of this environment that we can view it through. I hope that gives you something tactical as far as the timing and how I consider it. All right, next up, what are my thoughts on FXE? This is the Euro FX ETF. And my June options long put position, am I looking to hold for a break of 100? So great question, Greg. So what is my thought? My thought is this: we're in a great advantage right now. What do I mean by that? So first of all, being an exhaustion trader, the bulk of our position was built in this area right here, which is inside the wave. Okay, we did take a little bit of heat as the market got a little froggy, jumping and getting green, got a little froggy, but again, within our allowable paper cut threshold of risk. Remember, markets don't, anytime you're in a symbol, does it suddenly just move in our favor? I think most traders know it doesn't. It's going to be a little time where it's off course. And as long as we can build a trading plan that acknowledges that and allows us to manage risk, as it might be a little off course, we're going to be able to hold our position and our conviction for the fact that we have a macroeconomic trend and a technical trend dovetailing. That's pretty magical stuff. So with that being said, what I'm looking at here in terms of the downside is we've already taken profits. Why do I mention that? Not to boast, but to remind everybody that if I've hit a T1, I'm at a break even now. That's the important part. Not that we took profits, but that we're now protecting our potential downside. When we hit a T2, then now we've transitioned to a trailing stop. So rather than risking all the unrealized profit with a break even, which is necessary within some stages of the trade, this is all about scaling in, scaling out, the scalable mindset, the scalability of a trade. By T2, now I want to protect some of that unrealized profit. So that's the process that I teach in the Sector Secrets Mastery. That's how we can just milk as much as we can out of this FXE put. And then this is where I'm freed up to say, I don't really have to concern myself with T3 or where it goes next. I'm just going to keep moving that trailing stop until it either tags me out, which is great because I've locked in a certain amount of profit, or I start getting closer and closer to expiry and the theta decay starts kicking in and I exit because of that. So once we've hit T1, T2, it doesn't matter where it goes next. And neither do I frankly know where it goes next. Although I know the path of highest probability, the path of least resistance is, or we should say in this case, in the downtrend, the path of least support is to the downside. So if we can take out this Darvis, if we can take out this volume ledge, gosh, I think we could probably easily get down to 101.21. We take out 101.21. Next up, let's see if we can get to 170. So I'm just taking it rung by rung on this ladder. Look, I see every now and then, and this is usually clickbait type stuff, someone out there is going to make some outlandish call about where the euro is going to go next or where the S&P is going to go next. And it's going to be some ridiculous far out number, way below or way above. Nothing moves in a direct line like that. You know that. So as long as I know where the rungs on the ladder are, I can just take it one by one by one by one. So that's the way I would look at FXE, right? And this is how we free ourselves up to not have to crystal ball, because nobody can do that, the market, and instead say, look, what's the path to 100, Greg? And how do I protect my profit on this great trade if we're going to see that goal, right? So I hope that makes sense, and terrific question. And it's been a great trade. And I thank you for asking about a currency. That's awesome, Greg. Thank you. All right, moving on. Travel. When do I use propulsion dots as an aggro entry instead of the wave? It mostly travel. I will usually not use the 13. So let me get my drawing tool here and show you what I mean. So the yellow dots on my screen are the 13 propulsion, which basically overlaps with if you were to have a 13 exponential moving average, and that's sitting right there. See these yellow dots? Okay. That is the 13. I will seldom engage the market at a 13. I very rarely will engage the market at an 8. They're just too aggressive. I prefer most of the time the green. Now, the green dots are the 21. And when will I consider the green dots as a viable entry? Again, that's the 21. I want to see at least 3 to 5 dots in a row. And that's when I'll start considering that the cross of the 8 exponential and 21 exponential, which is part of the formula that activates the propulsion dots, is now validated why the dot should turn on. And then I want to see some consistency in the dots. The dots have to earn their spot on the chart by lighting up in the first place, and then they have to stay consistent to grab my attention. So 3 to 5 dots minimally, and then I'll consider the 21. And if you want to grab the propulsion, saying, Rog, hey, I like moving average crosses, I like the 21, head on over to countdowntrader.com and you can download the propulsion dots for Thinkorswim, and you can actually search simpler propulsion within the indicators on TradingView and put those on your chart. Now, if you're a Sector Secrets Mastery member, actually, if you're a member of the options room, futures room, day trading room, or my Sector Secrets Mastery, I've given you all my free tools and a layout with those settings. So if you're a member and you're saying, Rog, I do like this layout or these tools, go grab them. They're in the room drive of those rooms. So thank you for that question. All right. Moving on. Next question is, what are my feelings about Twitter and Musk? I really don't, Trader Mom. I had it up. Someone asked me about Twitter the other day, and I have no opinion. A market does this. I really am not going to engage it after that kind of move. Yeah, no. So what are my feelings? My feelings are I'm going to avoid pulling it up as to avoid getting sucked into the drama of what's unfolding. I'm not a momentum trader, so I should really mention that. So I don't want to engage momentum, and I don't want to tempt myself to. Am I out of CLOU? Nick, yes, we took our paper cuts, was it last Friday, I believe? So yes, we've been out at our paper cut level. And XLC too, XLC and CLOU. We were almost a 100% win rate in our mastery trades in March. And just to keep me humble, we had 2 losers. No, I'm kidding. We just happened to have 2 losers the last day of March, was it? The last trading day of March. So yeah, I had not just that CLOU, both of my ETF trades that were in the best, weakest, right? The best downtrends, the best, weakest corners of tech, even those went up with the tide and that rip higher that we saw in the QQQ. So it was the last day of March, and we took our paper cuts, and that's that. Yeah. So I'm no longer in CLOU, and I'm no longer at XLC, because again, we know what we paid for the trade. We know what that percentage risk is. It's fixed. When I set up a trade in a stock option, an ETF option, heck, in any option, even a futures option, the risk that ultimately that we had was really pre-calculated. I think a lot of traders need to know what their risk is before they get in a trade. So our stops are a fixed formula. So as soon as you enter a trade, as soon as you get an alert, you already know, oh, I'm going to be risking X of the setup of the cost of that trade. So those of you that might have seen our recap, we do those recaps actually before the month ends so we can get them out. I don't know why we do that. It actually doesn't make a lot of sense to do that. But I did the recap a few days before the end of the month so the office could send them out. And that's why it didn't reflect the 2 losses. But yeah, absolutely. We had 2 losses to wrap up the month. But I think we had, I don't know, some ridiculous amount of wins. But I love talking about losses because losses are where we learn to preserve capital. We learn proper position sizing, and we learn not to, go for home runs. We learn that we do want a certain difference in terms of, exposure to tech, but exposure to housing, exposure to currencies, but also exposure to consumer discretionary. And while I don't think that portfolio diversification is necessarily part of a book of trades, it kind of is, right? We don't want to pile into one narrative. If all my trades were hinging on tech, I would have had a very poor end of March. But instead, we actually did really well. And then the 2 sectors attached to tech, well, yeah, they tapped us out. All right. So, gang, as always, thanks as always for being a part of the Charts and Coffee crew. Go caffeinate and dominate, gang. We have plenty of Fed Speak today. Check out the weekly notes that I've sent you all. If not, check out the Forex Factory calendar and all those Fed events. By way of the speeches, we got a lot of chucklehead speaking today and even going into tomorrow. So be aware of that. It can move the market. Be good to each other. I'll see you tomorrow. Same time, same station.